But we are in a new era. We are in what I consider the third and final leg up in the precious metals. This is the leg that lasts. Actually, the duration is not that long usually, but the price appreciation is phenomenal. I always look for silver to confirm gold's move. It always concerns me when we don't see silver and gold not moving daily together, but when you have a very strong gold market and silver isn't participating, and we're now seeing it take place. So there's very little upside resistance beyond 33. As many people have stated, it's a fact. And, we're going to get to 50 this year. I highly doubt it. Will we see 40 this year? I started trading futures and got so much into the hard money, sound money camp. One of my first brokers said, nothing moves like silver and soybean. Not that you need that comment, but the idea being that they can move very rapidly.
Silver's impressive 34% year-to-date gain outpaces even gold's stellar performance, reflecting its dual nature as both an industrial commodity and a precious metal. The surge in silver prices is driven by a perfect storm of supply constraints, including mine closures and strikes, coupled with booming industrial demand, particularly in the solar panel sector. In a recent interview, precious metals expert DavidMorgan, also known as the Silver Guru, shared his insights on the current state of the gold and silver markets. When it comes to silver, Morgan describes it as historically recognized as the money of the people. He expresses concern when silver doesn't move in tandem with gold, as it typically confirms gold's price movements. Historical data shows that silver prices have underperformed compared to gold and palladium since 2011. However, this new demand from a major central bank could increase prices. The Silver Institute reports that from 2022 through 2024, global supplies of silver are projected to fall short of meeting demand by a combined 663 million ounces, indicating an already tight market that Russia's purchases could further strain. This move by Russia could significantly jump in silver prices, potentially by 50% or more within the next 2 years. In his assessment, Morgan points out that gold's nominal price has increased, but its real purchasing power remains below past highs. While he believes an all-out sprint in the gold market is approaching where investors fear the dollar's purchasing power will decline significantly. If you purchased $100,000 of gold in 2000, today it is worth over $530,000. Since 2000, the dollar has lost over 27% of its purchasing power, while gold gained an astonishing 530%. Based on his current analysis, Morgan expects to enter the final phase of a major upward trend in precious metals with significant price gains ahead. He points to historical patterns, suggesting that the end of market cycles often yields remarkable appreciation. Now, we present the clips of DavidMorgan's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
We've really seen the metals, do both well and not so well. I mean, when we started in 2000 at gold at 252, we're over, 10 times that amount right now in fiat terms. But in actual, real, true purchasing power, we haven't really gained that much. That's how when people say gold's making new highs, yes, it's nominal. The number 2,700 is a lot larger than 2000. It was just not that long ago. But in what is it in real purchasing power? It really has not reached the all-time high of 850 back in January of 1980. So that's point one. But let me get more specific on your question. I've said probably as long as almost 2 years ago that I already saw the run to gold beginning. And on many shows like yours, I've explained that central banks or the smart money was moving into gold at a rate that was unprecedented. They were buying gold basically hand over fist, but you weren't hearing much about it in the mainstream financial press. And I gave the analogy of the run to gold. And there's a lot of little sayings that go around the gold market that, a lot of people are familiar with, like there's no fever like gold fever, the gold standard, gold sets the standard, these type of things. And the idea being that at the last resort, the last monetary resort, money is based upon something of substance that can be trusted. And that means that gold is the number one most trusted money that has been voted by humanity over time. Not like we go to the polls, it's just what the marketplace uses the most often. So the breakout as far as psychology has been in gold for some time. And just to further that argument or that idea really is that the run to gold starts as a as I said, a slow walk, a brisk walk, a light jog, a full jog, a fast jog into a slow run, fast run, and then an all-out sprint. And that's an analogy for at the end, people that believe that perhaps the dollar is going to fail or is failing, or maybe that it won't fail entirely, but they know or believe that the dollar's purchasing power is going to be worth so much less in 3 to 6 months that they're smarter buying anything of substance than holding the dollar in a bank account. And that's the all-out sprint. We're not there yet. So now we have to look at silver. And silver really is the money of the people and has been for eons. But I'd say in the last 10 years, maybe even 20, silver has been put off as an industrial metal only, pretty much. I mean, you hear a lot of young guys and gals say, silver isn't money and blah, 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 blah. And in a way, the argument's really not that tough. Legally, silver is money. It's a legal fact. I mean, but I could take 4 1964 quarters, walk into a store, and what do you get for $1 these days? Half a pack of gum or something, some penny candy for $1, and they would have to accept it. In fact, most people probably wouldn't even notice they were silver quarters. They might notice they were old, stick them in the cash register. But economically, it's not money, because why would I spend something that's worth $2.50, 10 times the face value, so that dollar is worth 10 or whatever, or more than that, maybe 20. I'm not doing it in my head today, but significantly higher by many multiples for something that costs $1. Why would I spend something of fiat value that was, say, coming back on point? I always look for silver to confirm gold's move. It always concerns me when we don't see silver and gold not moving daily together, but when you have a very strong gold market and silver isn't participating, that gives me pause. And we're now seeing it take place. So there's very little upside resistance beyond 33. As many people have stated, it's a fact. And, we're going to get to 50 this year. I highly doubt it. Will we see 40 this year? I don't know. What I do know, I started trading futures and got so much into the hard money, sound money camp, and been there my whole life, basically, my whole adult life. One of my first brokers said, nothing moves like silver and soybeans. Not that you need that comment, but the idea being that they can move very rapidly.
In examining gold prices, DavidMorgan points out that despite a significant nominal increase, gold's real purchasing power has remained stable due to the rising money supply. The US M2 money supply has more than quadrupled since the early 2000s, which was a major factor behind gold's long-term uptrend that began at that time. As discussed earlier, a rising money supply erodes the purchasing power of paper currencies over time. The Nobel Prize-winning economist Milton Friedman described this process succinctly. Inflation is always and everywhere a monetary phenomenon. Since the year 2000, the US dollar has lost nearly half of its purchasing power, largely due to reckless monetary experiments conducted by the US Federal Reserve, which is supposed to be a good steward of America's currency but has proven to be the exact opposite. Highlighting a key investment strategy, Morgan advocates including 10 to 25% of gold in portfolios for optimal performance and risk management. He warns that neglecting this can leave clients vulnerable during market downturns. Let's get back to the interview.
A few things come to mind. One, before I start, is, the gold price in paper terms that we talked about. When I, got involved on the internet in, 1998, and about 2000, I wrote an article called Engineering the Price of Gold. Every once in a while, what's the paper price of gold? And in theory, it's very simple. You just take, for the U.S., what the purported amount of gold is and the amount of M0 base money dollars out there. And it's how many dollars versus how many ounces. It's a division problem. It came out 2,500 the ounce. And now, 25 years later, Jim Rickards just did the same, arithmetic. It's a division problem. And it came out 27,000 the ounce. So believe it or not, and this is the hardest concept, and I want this to get out first before I'm going to answer your question fully, is believe it or not, in terms of paper versus metal, you are actually buying gold today in today's value of $1, very similar to what you were buying in the year 2000, because the money supply has gone up that tenfold. in those 25 years. And so to tell someone, well, David bought his gold at, 300 and, now it's almost 10 times as much. Wow, he's made a killing. Actually, I've preserved my purchasing power and I have not made a killing. But that's an extremely hard concept. But to get the one, and I've had I'll call it an argument. I've had discussions, heated ones at times, with certified financial planners. I did work for one early on in my finance career, but the best studies in the world will show you on portfolio analysis that you must, and the word is must, own gold in your portfolio if you want maximum performance. And everybody wants maximum performance. And not only do you want maximum performance, you want maximum performance with the least amount of risk. Ibbotson and Associates did a study that was funded by BMG Group, my dear friend Nick Beresheff, who's no longer with us, and the number's 15%. Jeff Christian of CPM Group did it from 1968 on, and the number was 25%. And people like me recommend about 10%. And that goes back to what I said earlier about, people buy too much, buy the wrong kind, or jump in all at once or whatever. But really, it's been proven time and time again that factually, objectively, without any emotion, that precious metals are required. And this is what's sad about the financial planning industry, because they never are taught this. And there could be a day when some of their clients lose a great deal of money in the stock market, and they listen to a show like yours and say, my goodness, if I would have had 25% in gold, I'd be in the positive right now, even though the stock market took a massive decline. Or, the bond portfolio got wrecked because of interest rate fluctuations. But if I had gold in my portfolio, I'd be even, right? That level of, money management or whatever you want to call wealth managers, all these terms that they use are basically stockbrokers and most stock. But the point being is that they are undereducated as far as money, what it is, how it works, and what happens to it when you make too much of it. There's a lot of everything. It usually has low value. If there's a lot of yellow dresses at the women's dress shop, no one's buying them, they're going to discount them and they're going to put them on sale and try to move the product because there's so many of them.
While the future remains uncertain, Morgan's analysis provides a compelling perspective on the potential for significant price increases in silver and gold. As always, conducting your own research and understanding the risks involved is crucial before making any investment decisions. How should investors position their portfolios to capitalize on ongoing precious metals trends? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos.